Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, central bank bananas a week this week, so let's get straight into it. Let's start with the Fed because they kicked things off for us nicely yesterday evening. We're recording this on Thursday, so yesterday evening for us. Jan, what did we learn from the Fed yesterday?
Right. There's, of course, a lot to talk about, and I'll try to keep it as succinct as possible to allow everyone to also talk about their respective central banks. But obviously, we got the 25 basis point hike as everyone expected. That was, there was very little doubt about that, well communicated, and I should say delivered. The statement itself wasn't that different. We expected some of the wording to be altered to reflect that they might be coming to an end soon, or there's not that many more hikes left. That the ongoing kind of phrasing wasn't really changed. But what's changed was the addition that the committee acknowledges the kind of like the disinflationary process that started. They're still, of course, with the caveat that inflation is running well above where it should be, where they're comfortable, but it's trending in the right direction. The immediate market reaction to that was some small sell-off in rates. It came off slightly hawkish from the get-go, but nothing too shocking. However, as we went into the press conference, I have to admit, Powell was certainly a little bit more on the dovish side. A couple of things that really kind of caught our attention there. First, he was asked about financial conditions, and these days you can't really open up any news source without seeing a chart of financial conditions or discussion of financial conditions. And the whole point going to the meeting was that people expected him to push back because those financial conditions have been loosening. Well, he didn't really do that. When asked about the said FCI, he really ducked around the question, pushed back the focus on a longer term, something like a 1-year outlook, as opposed to month on month or like near term changes in those in the relative stance of tightening or loosening in financial conditions. When asked about his the Fed's December forecast, as a reminder, the Fed submits forecasts every quarter. December were the latest one, and where rates were projected to be in the 5 to 5.25% range. When asked about those, again, he ducked around, didn't really want to answer, basically saying that they will submit new forecast in March that should reflect their most up-to-date views. But that comes in contrast of the previous meetings where they either submitted a forecast, or if there wasn't one like in November, Powell guided markets into saying, well, we had forecasts in September, but we probably have to push them a little bit higher for a December one. There was no such guidance, which markets took it as a signal that they might be wavering. They're still deciding if they should do another hike after March or not. For the record, we do expect them to continue with 25 again in March and May. Of course, there's a lot of data before that, but and they will be data dependent, I suppose, like the rest of the central banks, and things can change. But so far, nothing from the Fed meeting has really changed our expectation of what's going to happen. He used, like I mentioned a couple of times, not even a couple of times, by our count, 13 times the word disinflationary, which kind of is entering the vocabulary now, and perhaps becoming the new transitory. And finally, the one I think he slip up, or I don't know if he meant it that way, but maybe his viewpoint was on when asked about how many more hikes there are left to do, and he did use the word couple of more hikes, which caught people a little bit by surprise, because that would imply that there's March and May ahead of us too that are live. But we'll see. I mean, on net, it was a dovish leading statement, and it was one of those things, as the economics team put it pretty well, I think, not so much of what was said, but what wasn't said that kind of made the difference for markets.
Yeah, I think that's the important point, because for the Fed, it wasn't one of the quarterly meetings where we got updated projections and an updated dot plot. So it really was just about the changes to the statement and then the press conference itself. But if you kind of compared and contrasted the two statements from the last meeting and this meeting next to each other, there wasn't a huge amount of change, but the market reacted in quite a significant way. And then we had, a follow through on the European Open this morning as well. Would you push back against that market reaction then, or do you think that that was actually fair, given, as you say, perhaps it was more about what wasn't said rather than the changes that were made?
I think it's fair, and I do acknowledge that after we record this podcast, we can go back next week and see some officials coming back and pushing back on their own side from the Fed. But my view is that markets will change. Markets will chase a theme in either direction. And right now, we've seemed to come to a point where you actually do have some disinflationary forces, most in inflation, most in the good side, but you have them. So it's hard to make the argument that inflation is picking up in pace. You are seeing some slowdown in data. We're not shedding jobs in the US, but we're certainly not adding them at the same pace as in the past. So it's hard to make the case that the economy is accelerating or overheating, but more so that things are more likely to turn towards lower growth or negative growth and lower inflation. So it becomes harder and harder for the Fed to maintain the message that they will hike and stay, or they will do even more, and they might come back and hike in the future. So I think that with that, the follow-up theme becomes, well, when do they cut? Because if they're not hiking, maybe they'll stay where they are, but at some point they will cut. And I think it will be very, very hard for the markets to take out the entirety of about 230 basis points of cuts that we have priced in. We can just shift them across the curve, but I think those expectations will stay there, and I think they might even intensify from here because we will. I do feel like we will get to the discussion of, well, when is the Fed going to cut, and the endless cycle of policy mistakes, policy errors comes back, and the next theme that the markets will go after, I think, is the whole the Fed easing thing, even if it doesn't happen and it's not an expectation, which means that it should be an environment supportive for risk assets, should be an environment supportive for treasury yields, but probably even more so real yields, because I think with our expectation for the next couple of months of inflation is actually not that soft. So if you combine that with the kind of like the relaxed stance by the Fed, you might see break-even inflation expectations actually drifting a little bit higher. So I think the green light was given, and the markets will go with that theme. The Fed hasn't really done anything to kind of stop that, I guess, further loosening of financial conditions.
Okay, you touched briefly there saying that you don't, although the market will price them in and you don't push back against the market pricing them in, you don't really expect cuts for this year. So has the Fed this week changed your view of near-term hikes, where peak rate is and how long it stays at that level? Or even if it hasn't, perhaps you can just remind us of what that base case view is.
Yeah, I should perhaps started with that too, but our view actually didn't change after the meeting, because the Fed will be data dependent, I would like to think they have been generally, but they will be still data dependent. And if inflation still runs pretty much in uncomfortable zone. So we do expect 25 basis points at the next March meeting, 25 basis points at the May meeting, which is above where the market's priced in right now. We have about one additional hike left on the curve. That's split like the distribution of that is 75 to 80% for the next one, or the spillover is like 20% for the May one. And so no, our expectation hasn't changed, that they will still deliver those hikes and maintain rates until the end of the year. What the market will price in we think likely will be very different from that, but our expectations of what will be delivered remains of 2 more hikes and hold.
Okay, cool. Right, let's switch over to Europe then, because another day, another central bank. Giles, Europe, or the ECB, was following an already big reaction following the Fed and the Bank of England, which we will get onto. But the market didn't seem to slow down into the ECB. So what was really the key message from Lagarde today?
Well, okay, so the first thing to say is that, of course, yes, absolutely, they were coming on the heels of some pretty dovish sentiment. I mean, the market was primed for the global central bank dominoes. They're all falling dovishly. So whilst I think the expectation was always that the ECB was going to be the most hawkish of the three, they may actually have had to do more in terms of demonstrating that dovishness in order to really anchor the market. And of course, they didn't do that. If you just read it and you don't know any of the context, you would probably think, yeah, that's quite hawkish. But the fact is that they weren't hawkish enough. And where market sees weakness, it goes for it in this sort of mood, right? So what we learned? Well, we learned that they are very, very focused on raising rates by 50 basis points in March. Okay, no surprise really there. I think that was always likely. In fact, exceptionally likely. The way that Lagarde actually put it was that we intend to raise rates, and intend, she says, is a strong word, but not an irrevocable commitment. Now, I think market's probably looking for irrevocable commitment.
Is that her words or?
No, her words. I quote directly.
That's like a little learned before from committing.
Well, sorry, I could have tried to affect a female voice, but just for extra emphasis. But I think that could have turned a lot of people off.
We don't.
And then she went on to explain that what does that mean? Well, basically it means, yeah, we're data dependent, but we can see enough inflation sort of upside in the pipeline that pretty extreme scenarios only would knock us off that path. Okay, and that was her expression. So 50 basis points in March. We had 25 actually, and I still think that the risks are on the downside, but you got to listen to them, take them at their word. I think you probably get 50 basis points in March. I don't think that's worth fighting. But thereafter, wide open. This steady pace. Now that extends to 3 rate hikes of 50 basis points, and that's it. And so whilst she says, no, we don't think that with the next 50 basis point move we'll be at the peak. Well, no, that's pretty weak. The markets will take its view. I mean, by May we could be in a very different place. We've penciled in 25 basis points for that meeting. So we've actually, in spite of this very dovish mood, and the massive rally that we've had, we've actually increased our peak rate forecast, which was at 3%. We put it at 3.25. So there's a little bit of convergence between us and the market there. And markets are still higher than that, actually. So I do think there's still some value in the very front end.
Does anything about today then change your views, I guess, going forwards, where you've already talked about the fact that you see a slightly higher peak rate, perhaps, but what about longer dated rates or spreads even? I guess just your key themes for Europe.
Yeah, I mean, it does a bit. So in spite of raising our central case anyway for the peak rate to, again, I'll repeat, 3.25, but with some downside risk, it doesn't actually change the fact that we're bullish on the very front end. And increasingly, I think that if we get ourselves into a situation in the macroeconomic environment where we're seriously talking about rate cuts on a sort of forecastable horizon, that's going to rally the very front end, and we're going to see steepness. Okay, and so we've seen, for example, 2s, 5s continuing to bullishly invert, and I actually think that is one thing you don't go with. I think that's something you oppose. I dare say we'll have to review the timing, at least, on our bearish Bund call. So maybe I'll ask for that next week. The other one is view on Italy. Today and yesterday have been exceptionally positive for credit, and Italy has been really, really strongly outperforming, swept up with that great mood for credit. I don't think you oppose that either, to be quite honest. I think the main question at this point about Italy is possibly that there might be, this might be a good moment for the ECB to try to use redemptions to buy a little bit less Italy and try and rebalance there. So So that might be a little bit of a background negative, but overall, I don't really see enough headwind there for to be negative, honestly. So, with that, should we round it all off and go back to you, Imogen? And I'm going to ask you the same question that you've leveled at both of us. What have we learned from today's meeting and announcements from the Bank of England?
Yeah, last but not least,
Absolutely not least.
So in some ways, the Bank of England could, and perhaps maybe was, the more interesting meeting in that we had, updated projections as well. This was kind of their quarterly meeting, not just the with a press conference, not just their usual press release that we get kind of every other quarter. It was 50 basis point hike as we expected, but delivered dovishly, which I think was in line with market expectations. We spoke about that on the pod this week, and I've had a lot of client conversations this week, which suggests to me that was kind of market expectations. But actually, I think it was more dovish than we were expecting, and probably a bit more dovish than the markets were expecting too. I think there were two key dovish elements of the changes to the guidance. And I should note that actually the vote itself was 7-2, so 7 in favor of 50, and 2 votes for unchanged, as there was in the December meeting as well, which actually was a little bit more hawkish, I think, than base case. So the vote was slightly hawkish, but actually all the changes to the guidance and the language in the minutes and the tone of the press conference massively outweighed that kind of one slightly more hawkish element. So the changes to the guidance that were important was the removal of this word forceful, and also how they talked about what future rate rises might be required. In December, they said that if the outlook suggested more persistent inflationary pressures, it would respond forcefully as necessary. And in February, or today rather, they said if there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. And there were some sentences in the minutes that I felt were quite peaky, I'm calling them, or, indicating that the bank at least thinks that we're close to peak rates. They said that a 50 basis point hike at this meeting would address the risk that domestic wage and price pressures remain elevated. And they explicitly acknowledged for the first time that although there are lags in monetary policy, and they've acknowledged the lags before, but it's the first time that they've talked about this idea that they front-loaded hikes and that an earlier and higher bank rate peak might mean that actually brings forward the point at which recent rate increases would need to be reversed. So there was a lot of, like I say, peaky language in there, and there was a lot of questions around whether, if the economy evolves as they see in their central scenario in the forecast, does that mean that we get further rate hikes? Now, they didn't really answer that specifically, I wouldn't have said. They sort of skirted around that question. They were quite keen to emphasize the upside risks to their central scenario on inflation in particular, and that they were very asymmetric, those risks. And so I felt like the key takeaway or the key message was that they were saying, if the economy evolves as we currently have in our central scenario, we may not need to hike rates anymore. But actually, we're not really emphasizing that point because we think the risks are so skewed to the upside in such a significant way that it's more likely that we will need to hike rates at least once more, if not more than that. But I think the removal of the word forceful, and we learned in the December meeting that to them, forceful probably now means 50 basis points, that, it's more likely that we're talking in 25 bip increments from here onwards, I think.
Yeah, I mean, I have to say, I'm just listening to you. I'm very confused about why they would continue to raise rates if they think that brings, forward meaningfully the point where they would have to cut rates. Now, surely it would be better just to stop a little bit earlier and stay there for longer, which was essentially what I thought was going to be the message from all central banks. But clearly, I was way off the pace there because that's not what we heard from anyone. Nonetheless, anyway. When it comes to the UK, I mean, in common with everyone, we've had a big rally. Is that something that we should be considering and go with? Is there more momentum in this?
I mean, the front end had a lot of scope to rally. The front end has consistently been pricing a more hawkish reaction function over the next couple of meetings than we had in. So, it's been rallying really consistently since the beginning of this year and even beyond before then. So it's now kind of in line with our base case view that we get one more 25 bip hike in March, and that's probably the peak rate. And, we think that rates stay at that level as we've just discussed for the rest of this year. So in terms of where we see peak rates, I think it's right that markets have adjusted much closer to our view. And they see a little bit of upside risk a lot beyond that 25 bits, which I think is probably fair too. I think actually the skew of risks are such that we're more likely to get another 50 in March than we are to get 0, for example. Beyond that, though, markets have been pricing in a cut, pretty much a full cut almost, between sort of June or August by December of this year. And I think we spoke about this last week, that they're now pricing in kind of 35 basis points of a cut, which feels aggressive to me. It's not that I don't think that the bank ultimately will have to cut rates, but just not this year. And similar to what we've spoken about in the US and in Europe, a cut that soon after finishing hiking rates almost feels like kind of policy error pricing. And that would be sooner really than the bank have ever cut rates after reaching peak rates in a cycle over the last, more than 20 years. So it would be a very quick turnaround from also quite a low peak in rates versus where we have been historically. Obviously, it feels like high levels of rates compared to recent history, but when you look back over a much longer time period, it's still quite a low peak from where they've previously cut more quickly from. So to me, that kind of a turnaround and switch up in policy is where I would push back more on market pricing, particularly against a backdrop where it feels like central banks are so concerned about second round effects that the hurdle to easing in this cycle, I think, is maybe a bit higher than it has been previously. And we still see quite sticky core inflation pressures into the end of the year, which is why we've long held this view that cuts won't come until 2024 anyway. So I would just push back a bit on that, quite considerable cut pricing from markets, I think.
Yeah, nonetheless, just as, again, just listening to you, I reflect that we have, in the European context, again, we have this language about sort of raising rates to a level that's sufficiently restrictive, for long enough, essentially. But how long is long enough? I mean, that's got to be an increasingly important question. And if you look, for example, at sort of 1 year real rates, they're nearly 1% in Europe. If we do have the level of disinflation that markets now seem to be expecting, and you have a meaningful slowdown in the economy, then that looks pretty restrictive. And that takes you 2 years from now. Maybe that's more than long enough. So I think that there's some stuff here for us to think about.
Yeah, I guess it's not just about the length of time that we're in that restrictive policy for, but how restrictive that is over, where we consider neutral to be, which is probably a discussion for a whole other podcast, which would take a lot longer than we have here.
I think so.
Okay, listen, I think that was a good enough roundup of this week's central banks. We'll be back next week for hopefully something else other than central banks. But thank you all for joining me. Thanks to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button or click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.